Rohr here with an earlier than usual global view on Thursday, March 6th, 2015. It's currently 5:45 a.m. U.S. Central Time, and much as before yesterday's ECB meeting and press conference especially, we wanted to get our chart views and comments out in front of you prior to the release of the U.S. employment report at 7:30 a.m. U.S. Central Time. So, what has all this meant to the markets? Well, yesterday's reconfirmation from the ECB that it's going to be engaging in the aggressive QE program laid out at the January meeting of 60 billion euros per month of bond and other debt instrument purchases, along with that running all the way through September of 2016. And in fact, even allowing immediately that they might extend it beyond that if inflation and growth are not bounding back in the way they'd like. Well, that still did quite a bit of good for the DAX, the German equities yesterday, but the U.S. equities actually took it a bit lackluster. We're looking, of course, at the S&P future, March contract on the left, and the hourly of the March contract on the left, 30-minute on the right. And what we see is after the early positive response, putting it back up above 2100 temporarily, the market kind of drifted sideways the rest of the day, even if the dip only took it back down around Tuesday's low once again, around 2096 before stabilizing. Now, of course, the key near-term level is the fact that on the way up, going back to Wednesday, a little later on in the day, it did manage to put in a nominal up break out of its overall downward trend since the Monday push up to 2015, which was retesting the 2015 to 17 resistance set by the push up on the back of Janet Yellen's accommodative comments last Tuesday and Wednesday. And yet breaking up from there, it appears still kind of stagnant, almost like with the ECB having been expected. It's waiting to see the non-farm payrolls number and other employment report data today. So a nominal up break from around the 297 area, but with the far more major support still back around that old December 2088.70 previous all-time high to the push up the market took into the early part of February. And that also leaves the resistance still up at the failed up breaks and previous down breaks right around the 2104 to 2106 area. So if it's back above 2104.06, wouldn't take much imagination to think you're going to print up into 2015 to 17 again. If it can't get through there, at some point it's likely to attract selling, and we'll have to see if it can hold on into that old 2088 area. And we'll see more of why that's important on the intermediate term charts, but that pretty much does it for the short term view of the S&P 500.